When I was younger, I wanted to become rich and successful. I wanted to be able to live free and buy all the tech without any restrictions. So I decided to work my ass off in a corporation. Working your ass off for an employer won't get you rich. It took me 8 years to realize, but in order to get successful, you need to take risk. Either by starting a business, finding opportunities, or by allocating capital. There are no courses on how to allocate capital. And the rules are totally the opposite of what you'd expect. Here are my lessons in investing in stocks, so you won't have to make them. So how do you even start buying stocks? Well, you follow someone on YouTube or follow an important investment guru, keep a track on the trades and buy their stocks and call it a day. Easy. Oh, stop. YouTube is full of people recommending you stocks, promising you 10x for every stock they buy, but they bought the stock because of something that you won't have if you just follow them. And that one is super important. That is conviction. You build conviction by analyzing a company, following it, and keeping track of either the charts or the fundamentals of the business. You can do this by following quarterly earnings calls, tracking progress in the P&L and balance sheet, and by doing research on the CEO or management team or the business practices they perform. If you don't have conviction, you will see the stock plummet and you won't have any idea of what is going on. You will blame that person while it was your own decision to buy the stock, while you started to invest because you wanted to take control of your own financial fate. Use the perspectives from others to challenge your own analysis or thesis. But if you don't have conviction, then during rough times, you won't be able to hold on to these stocks. So what's the point of buying a stock if it only keeps on going down? So the stock market is full of investors that only buy stock once they go up. This is called FOMO, fear of missing out. And if your luck is bad, this can lead you to buying a stock at the top and not maximizing what you actually want. And that is your returns. So if you go to the store and you're shopping, generally you're looking for items that are actually in a discount. You will never ask for something to buy at the full price. The stock market works in the exact same way. Even though it can feel extremely painful, scary, and even uncertain to buy stocks when they are going down. This is the moment when you are making your returns and can outperform the stock market. Buying companies that you love on a discount. I am continuously looking at the companies that I love, and once they go on a discount, it's time to buy. However, there is a time where you can take this approach to an extreme. I see tons of messages every day. I will wait for the bottom. The bottom is not yet in. More pain to come. Yes, you're able to get the maximum return if you buy in at the bottom. So let's say you have this amazing company that you love. You see a wonderful management team and the results are just awesome. But even with this discount, the stock is trading at a high premium. The multiples are high, it's an expensive stock. The stock goes down 10%, but you don't buy. You're waiting, you're waiting, you're waiting. You're waiting for the perfect moment. The moment where the bottom is in to get a juicy return. But then the stock goes up and you miss the boat. This mistake can cause you to never own the stock because you were waiting for that perfect moment. But newsflash, you can predict the future. No one can. If you still want to get those returns and still have the idea that the bottom is not there yet, there is a solution. Don't buy everything in one shot. Use dollar cost averaging to buy your way down in batches. Buying your way down in batches will lower your average cost basis and will eventually increase your returns. So what if the stock never goes back up? You bought this wonderful company on a discount, but for the next week this stock is getting slaughtered. You look on CNBC and the only thing you see is negative headline after negative headline. You start to develop a negative relationship with this stock and don't believe this will recover and you sell. While in reality, this was just some short-term selling pressure or temporary issues with the company. You got fooled. Ask yourself the question, why did you buy the stock in the first place? And why did you decide to sell the stock? It's your job for you as an investor to separate the noise from the facts. Negative headlines does not mean that the fundamentals for the company have gone to shit. So if you're new to the stock market, how do you even pick a stock to invest in? There are so many options, but you have no idea. Where do you even begin? The answer is simple and clear. Invest in the area you are passionate about. If you are passionate about a topic, you follow all the news about this topic, developments in that area and who the top players are. Believe me, you will think that this is common knowledge and that everyone knows about this. But this is wrong. You are passionate about this topic. All other people are not as well informed as you are. They are not the expert on this topic, but you are. You have the edge because it's something you're passionate about and you love. Wall Street does not know the same things as you. You have facts that others don't have. You are the expert. This gives you conviction. Do you know that feeling that Wall Street doesn't get it? Follow that feeling and trust your own research. This is where you can find asymmetric upside in the market. And it's damn exciting. Let me know in the comment sections which stocks you think that Wall Street doesn't get and why.